Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, April 10th, 2023. It's 9:55 a.m. Eastern Time as I'm starting the video, and we'll do a quick update. And really not a lot new to update. I just wanted to reiterate my outlook on the equity markets, Treasury bonds, precious metals, and we'll do a quick update maybe on natural gas. All right, starting out here, most importantly, my focus has been on the markets, and we are heading into earnings season. So I'll get to that in 1 second. We've got some of the big banks coming up this week, mainly on Friday. That's going to be the big day, and let's just talk tech, because again, tech is the market. Make no mistake about it. These are the stocks that have the biggest weighting in the indexes, and so not only is there psychological importance, a big one, but also the mathematical weighting on all the indexes, the big indexes, the S&P 500, the Nasdaq 100. So we're back to where we were last week. This is, to me, a big level right here, this 313.62. We hit it there the other day, and I mentioned, for swing positions, staying, even though I fully expected a bounce, a reaction off that level, said it wasn't really, in my opinion, worth gaming, and I can only say this: we're back there again. So if I had no intention to game the first reaction, I have even less of a desire to game the second reaction. And again, now as an active trader, now I'm talking about my swing positions. Don't get me wrong. There's probably going to be a little bounce here, maybe not, but a lot less of a chance than there was last week when we hit it, because the way this works is, and just like my price targets, the initial tag of a support level from above when you pull back is likely to produce a reaction, again, depending on a lot of things, but I'll share my thoughts when I think a bounce is likely or not. But once that initial tag has happened, that's usually it. And so again, I personally, I don't think it's worth even active traders trying to game a bounce off here. We already hit it once, and then the technicals, and this is why I'm doing the video, we have some more check marks today. So first and foremost, we had this uptrend line on the 60-minute chart, gives us this big wedge pattern, divergent high 1, divergent high 2, made that marginal new high. Had a breakdown, hit support again last week as highlighted, bounce, made a perfect back test, and a pretty hard rejection. So once we clear this level, pretty much last week's lows, if you want to be safe, I said it last week, is maybe 312 if you want to, if you're looking at the daily time frame, that should open the door to more downside. But that's that. We're at support right now. We're heading into earnings season. It's really starting to get underway this week. I'm going to go over that 1 second, and let me show you a couple other things on the futures. NQ Nasdaq 100 futures have the comparable level to that 312.62 on QQQ. Or was it 313.62? It was right here, 12,973, and so it's more of a support resistance zone right there, because you had two reaction highs in NQ, and again, we hit that level last week. That's where we bounced, and so you're pretty much looking at QQQ here, although this is the NQ Nasdaq 100 futures, but you see the round-the-clock trades, so you can see you had a little bit of a divergent low right there, but you broke down, you made a perfect back test, rejected, and you're back down to support. So that's it. Big support level. The fact that we've had additional reactions. Remember, these are the lines I've been focused on lately. And the fact that you've had two more reactions since I've started really highlighting these levels on QQQ and NQ. That helps to validate it. Now, again, I've said it many times recently, and I know there's a lot of at least some out there that are bullish. Tell me you're long looking, and these are, yeah, you can buy pullbacks to support. It's not a support level I'm buying. It's told you why, based on my read on the charts, not just these 60-minute charts, but that's a level that I think will ultimately go, and I think sooner than later. And I'm not going to let earnings season deter me. The big market leading FANG stocks and the big tech stocks, they don't report till later in the month, so we've got a little ways to go there, and I think we'll see. Like I said, I think the rally was I've I've had a hard time putting in words, but I think it's almost ludicrous, the fact that tech stocks, when the economy is clearly rolling over, just about every metric is pointing to either a slowdown or an outright recession. To me, the debate's more of a matter, is it going to, how bad and how long is the recession going to be, whether or not there's going to be one. But I think the street's still talking about whether there'll be one or not, whether the Fed will engineer the soft landing. And again, that's just my opinion, right or wrong. I think that's ridiculous. So, and then the fact that everyone's been piling into growth stocks, especially lately, is even more ridiculous. That's just, it doesn't make sense fundamentally. And again, first and foremost, you guys know this, mostly what this site is about is technical analysis. I do factor in fundamentals, but technicals are first and foremost. So let's get to that. So today I got a price alert on Apple. So you know what's going on QQQ, and as I always say, any index or sector is simply a sum of its parts, and the parts of QQQ, by far, it's still top, handful of stocks, half dozen or so, account for the vast majority of the returns, over 50%. And so I had a price alert today on Apple. I had an alert set, actually not a price alert, I had an alert set for a bearish PPO crossover. You guys know I always say the market is not going to roll over or go down hard until Apple rolls over. Apple is the king. So here's the daily chart. Again, I've been focusing a lot on the 60-minute lately, but the daily is more significant, in my opinion, by far, than the 60-minute charts, especially for swing and trend trading. So there is our bear market downtrend line, and that's a beauty. That's the all-time highs right there in Apple, late December. Second reaction, third, and these are clean, distinct reactions. Again, anybody can see these. You don't have to struggle to see that downtrend line. A perfect rally into the bear market downtrend line recently with clear negative divergence. The last time we've had negative divergence on Apple on the daily time frame was when the stock topped at the end of the last bull market, and that was followed by a drop before all said and done into the early January lows of 32%, in which case we were long Apple, or I stated that personally, one of my favorites here on the site. And well, actually it was a handful of the FANGs. I think Apple was in there, Apple, Amazon, Tesla, and expecting outperformance, and that's what happened. But that outperformance carried a little bit further than I expected, although I did highlight all along the way this was a potential target, and that's what we hit. So where I'm getting at, we stretched to the, pretty much the upper limits of where Apple should have went, and I think it has quite a bit to fall, in my opinion. Now, with that being said, my thoughts, my guarantee, the only guarantee I ever give you is I'm going to be wrong, and I'll be wrong a lot. So, if Apple breaks that, it will be a check mark for the bears, but it won't put a nail in the coffin for the bearish case yet. Apple still has the last major reaction bear market high right there. In one single stock, invalidating a downtrend or calling a downtrend into question doesn't completely negate the whole bear market scenario. But it is a check mark for the bulls if Apple can clearly break out of the trend line, if it can clearly take out these divergences. But honestly, I haven't seen as good a bearish setup in Apple in a long time. We had this clean up trend line. We shorted that. And there was a sell signal for the market, and that's what we've been doing. We've been zigzagging down. Bigger picture, turn off all the lines. It gets busy, busy, busy. This is Apple. Apple's been one of the strongest, rightfully so. It's one of the best run companies out there. It's a cash cow, but in a bear market, just about everything's going to go down, and usually the leaders will ultimately roll over. And Apple, again, Apple's already been down over 32%, so it's not like we're not in a bear market, but that's it. And I just wanted to again reiterate that we have now this fired today. Now today is not over, so Apple could rally to close green today and undo this bearish PPO crossover. That's what I had the price alert on, or an alert set, not a price, but an alert for a bearish PPO crossover, because that would give me what I call confirmed divergence when you've effectively put in a lower peak on the PPO right there, and of course the RSI. So divergence. And now the next sell signal on Apple, and it'll be a nice one, comes on a break below this big bearish rising wedge pattern. You have a nice clean uptrend line off the January lows, quite a few reactions. And this is probably where they'll come in and buy it, one last little gasp. But this wedge looks ripe to break. But by that I mean most wedges will break down somewhere, give or take 70-80% towards the apex of the wedge. Usually don't make it all the way to the apex. And so this wedge could break down anytime. Again, it looks ripe for a breakdown. One possibility is maybe the markets will go into a holding pattern leading up to the reports from Apple and Microsoft and Amazon and the like. So that could be a grind around for a few weeks, which would serve to frustrate both bulls and bears alike. Anything's possible. But like I said, to me, these are the levels to watch. The downtrend line, a solid break, and again, it's not a one-day thing. You might pierce it. It's more of an incremental. The further away you get away from there, the more green that check mark for the bulls becomes, and the same thing on the downside. So you have the uptrend line, and then 157.50 right there is really good support in my opinion as well. So that would be quite bearish and give the bears a check mark. So those are the levels I'm looking for on Apple. I don't want to make too much over one stock, but it is an important one. And so that purple, I should put a little purple circle there. This is not finalized. My alert came right after the open today. Apple's down 2.5%. So if it can rally back up, great. For the, I think it just delays the inevitable. Again, you can kind of eyeball these charts when you look at things like the PPO histogram, showing you the momentum has been waning. You have divergence on the histogram, just like you had divergence there, and then eventually the histogram crosses, and that's where you get these bearish trends. Red trend. I'm trying to use my box tool. Bearish trend, bearish trend, bearish trend, and the PPO, below the zero line, and that's it. So. And we had that little crossover, and you're going to zoom in real tight. There it is. You can see the histogram flipping red. So let's not make too much of it, but it's just worth pointing out. Let me go to a couple other things here for you. Microsoft. You also have, again, if my chart will populate with the lines here, let's try this. Sometimes you got to wake it up by doing this. Draw a little line. There it is. Delete that line. Same thing, negative divergence. Forget about everything else. You have the negative divergence right there. Potential. I'm not super crazy about that uptrend line, but I am. The divergence means a lot to me, and there it is. So first negative divergence on Microsoft since right here, and that's what happened after that divergence, that drop. And you had divergence right here, and that was the all-time high. And really ended up with that drop. So that was a big divergent low right there back in November, and it gave us this. So wash, rinse, repeat. This is where I think we're going, and we'll see. So I won't go over each and every one, but the common theme is nearly all of these market leaders have on that all important daily time frame the negative divergence recently, and they're down today. All right, so remember, with earnings season comes volatility. So we'll just watch these levels. I'll get to the earnings in 1 second. Let me just cover Treasury bonds first. I told you last week I took a short on ZB Treasury bonds. That's the 30-year. Let me go to this. I think I had 6-month 2-hour candles. Yeah, I did. That's what I showed you last week there. This seems to be the a cap on ZB, the 30-year Treasury bond futures, and in each case you had a divergent high there. Boom, correction, divergent high, right there, correction, divergent high, correction, and DH2, little false breakout. All the better when you have a false breakout, because that's what we call a bull trap. Bulls buy the breakout, bears the shorts get sucked out, and so pretty good reversal today. And again, nice big negative divergence. So I told you last week that I took this as a partial indirect hedge. Remember, a direct hedge, if you're short QQQ, you can buy calls on QQQ, for example, or things like that. That's a direct hedge. One goes up, the other goes down. Indirect hedge is just like it sounds, it's not direct. And so typically, if the stock market corrects, normally money goes into treasury bonds as a flight to safety bid. But I said if I'm lucky, and so if that was the case, then that would hopefully hedge out my swing shorts. I could hold on to them a little longer because I still believe they're going to play out. And then if I'm lucky and smart, call either one, then you can actually see both the stock market and treasury bonds go down because there's a lot of factors that go into treasury bonds. So flight to safety thing is only one of many. There's other supply demand factors, whether it's other countries selling U.S. treasuries, whether it's what's going on in the U.S. dollar, whether it's what the Fed is doing with quantitative tightening, easing. Again, there's a myriad of factors. So you don't, this flight to safety thing or treasury bonds going up when stocks go down, well, historically that's been a pretty consistent pattern, but we know since the bear market started back in over a year ago now, year and a half ago almost, that bonds and stocks for the most part have been positively correlated, going up and down together. So again, that would be ideal. And again, it's simple. Well, there it is. It started to play out. You got the rejection. No reason that this, you could make another marginal new high, but I think it's prudent now to put stops probably even a little bit below that high. If they run at it, they'll probably want to pop it. So either at least at or slightly above, or I should say the previous high on Treasury bonds, and then there's a potential trend line. We'll probably get a reaction on it, and then this big old wedge, if it breaks down, is probably going to take us back here. If you want to know where I'm eyeballing right now, it'd be that 129 level there on ZB. And I know a lot of you, or some of you, don't trade futures. That's fine. TLT is you can buy TL or short TLT, align the levels to a comparable level, or you buy TBT, which is a 2-time leverage inverse 30-year treasury bond. You can go with the 10-year for a little less volatility, that's IEF, or you go with CN, the 10-year treasury bond futures. This is just a 3-month chart, 60-minute candles, but you can see comparable resistance, and we just hit it there, and that was actually only thing I need to do to update this chart is just extend the divergences, because we made a roughly an equal high on that last divergent high, and so this is just DH2, we'll call it, and just copy that. Second divergent high there, or a larger divergent high if you look at how we've been diverging there on the indicators, and maybe a trend line right there. I don't want to force it, but there's enough reactions. You got a couple right there. And then recently, yeah, you did. You had a little bear flagging right there. See, let me zoom in and show you. Okay, you had a impulsive thrust down, a little flagging action, broke down, and so that's how treasury bonds look. Quick update in gold and silver. I'm also looking for a pullback. I hate to be overly bearish on almost everything. There are a couple things I'll give you as longs in the commodity arena. Lumber's looking interesting. Natural gas starting to look interesting. But this is gold. You had the uptrend line right there that broke back in January with a divergent high. That was a DH right there, divergent high, negative divergence. Set up this downtrend, this correction, which we gamed. That put in that divergent low at the bottom there. You had divergence right there, and then you made an equal low to extend the divergence, gave us this rally, and now we've come full circle with a divergent high, and now you have this uptrend line. So that breaks, probably take you down there to 1963, and maybe quite a bit more. There's some pretty good negative divergences, and that's the 120-minute chart of GC, gold futures, so 6 months of price history. Silver probably get more bang for your buck on the downside if gold drops, and I'm trying to queue up the silver chart. Here we go, right there, SI 6-month chart, 120-minute candles, divergent high back here. We had our sell signal when gold broke down, and silver gave away below that 23.47 support. Gamed most of that pullback in the miners and the metals, and then we put in that divergent low, and that's where we're at. We've come full circle. Divergent low is played out. There's your uptrend line. It's a pretty pretty big and pretty steep uptrend line, and we've been diverging. And silver broke out. The futures broke out. That's 24.88, I think. 24, yeah, 88. And so a lot of eyes were on that level. So same thing. You have the potential for a nice bull trap there. If that, you can see that little pocket of consolidation there. If it breaks, it's also going to be a break of this steep uptrend line, and it will be a failure of the breakout and give us that bull trap. So at minimum, I'm looking for a pullback to 23.47 right there if we get sell signal on silver, and I think it's pretty likely. Lumber's starting to look interesting again. There's been some nice swing trading ops on this one in the last couple of years. A lot of volatility. Lumber tends to set up in these, parabolic runs quite often. Those are these curvy, trend lines. These are parabolas, and those never end well. They're great to be long, and then when they break, you can use the parabolic trend line as the support level too, and you break, and then you have a hard correction. Anywho, I wanted to show you that since 2009, this has been the uptrend line in lumber, and we've come back to it, and you can see each and every time that's where you want to be a buyer of lumber. And so it hit it recently back here in early 2020, and we hit it again most recently right there, popped. We took out this steep downtrend line, and we had positive divergence there. Now I'm looking at the indicators, PPO's rolling over. Coin toss odds whether we're going to make another run or a slight cut through there, but if we do, we're going to have even larger divergence. Now it might be worth a shot because we already had tested the support right there, and that may be all it takes. Usually it's one and done when you come back to these trend lines. And again, with the positive divergence, tells me that whether we come at it again or even a slight undercut, probably going to go up. Now normally that might not mesh with the whole recession scenario, but it may. Like one of the things, and I know there's been some chatter and discussion on the board. I've been bullish and pretty adamant that I believe we're in an early stage of a new bull market in commodities. And part of that, there was an article I posted for someone on the site, one in the comment sections, that talks about, when you go through these bear markets. Remember, we've been in a pretty vicious bear market in commodities since 2008, and that bear market ended in March of 2020 with the COVID lows. And what happens is production shifts. It's a more of almost a generational big shift, and then you get to the point where, because commodity prices have been falling, you don't have the production. And so that is one of the things. You could see the housing market soften, and still lumber prices, it's possible they could rise against that. Normally lumber prices go up and down with the housing market and the economy. Obviously, for the demand, you build houses, you need the framing. But it is possible if you've seen a lot of lumber come offline. Either way, the technicals are there. It's not a hard buy right now. PPO is pointing down. This is an end of day chart, by the way, guys. This one will be updated after the close today. It just shows through last Friday's close. I believe the futures traded on Friday, even though the stock market was closed. Either way, then it would be Thursday. The date's up here somewhere where it is. Oh, April 6th. So that's through Thursday. Friday, I believe, was the 7th. All right. So, but let me show you what the futures look like right now as of today. LB. This is a live chart, 6 months price history, and let me change up the color of my tool here. You can see, you get these little divergent lows, you get rallies. Divergent low, 1, 2, equal low. The divergence just got bigger and bigger, just like I showed you the negative divergence on the stock market. And then finally, after that second equal low, to extend the divergence, boom. Ended with a negative divergence. Boom. Steep downtrend line, breakout, and a rally. And then all along, it put in this big divergent low right here. So here, let me clean out all the lines right there. So from that point to that point, this was all big positive divergence. And then you had a little minor downtrend line breakout right there and starting to move up. And this level I had here is support before. Not a hard level. We pierced it just a couple times briefly. But you can see a lot of reactions around that level, and then we broke it here, and now we've recovered it. So, I think it's worth a shot maybe for a small position and maybe layer in. Um, Again, I have my concerns. I think the market's going to come down hard soon. Um, Looking for pretty significant leg down, the next leg down in the bear market, and lumber may come under pressure there. A lot of things when there's forced selling. If the market does what I think it's going to do in the next couple months here, then yeah, you get that forced liquidation, margin calls. So people that might be bullish in lumber, might have bullish fundamentals, if they start getting margin calls because they had too much QQQ and Apple and Facebook and all those things that have just uh, are, in my opinion, insanely overvalued right now, and also more importantly, very bearish technical posture, then those things may come down. Let me just fix this line right here if I can grab it. Fix that, delete that. I just wanted to come in and can see we had a little bit of support and a little flagging right there. All right, let me get away from that, give you one more and wrap this video up. Natural gas. Had a couple inquiries on that last week and gave you this chart here, if I can find it. NG. Bear with me. Let me pause the video. I've had it somewhere here. Okay, I'll start out with the long term. This is nat gas futures, the continuous contract from a long-term chart. And what I would highlight here is it's not a hard buy by any means. I love to see on the weekly, but you don't always get it, divergence. You do often get it on the RSI. I'm circling the major lows. That was positive divergence on the RSI, 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 and we do have, I'm going to add it right here, a positive divergence on the RSI. Not on the PPO, but again, quite often we don't have it on the PPO. All the better when you can get both, but we're also oversold. That's the thing as well. You can go here, I'm going to just circle. Oversold's not a buy signal, but you hit it there first. You did have a rally. You hit it again with the divergent low. So that's it. There's we're getting down to, again, this chart goes back to 2008 right here, and you can see natural gas is a volatile little sucker. It's the nature of this beast. It's often full throttle up or full throttle down. That's how it tends to run. It's hard up, hard down. There are periods of consolidation, but you can see how strong the rallies are and how powerful the corrections are. And you can see that, again, it is a commodity, and the one reason that, among others, I like commodities for all the other technical and fundamental reasons I stated. But one nice thing about them is they don't surprise you with any corporate malfeasance. They don't, shenanigans on the books. They're not hiding losses, marking stuff to market, or marking it to fantasy instead of marking to market. There's no bankruptcy filings. None of that stuff. These are commodities. They're going to be around. You're always going to need it. Power plants run on natural gas. A lot of houses, heat. And so it's here to stay, even despite the current administration's war on fossil fuels. And so what you're looking at, we're in a commodities bull by every metric. You can debate whether that bull is going to continue. That's certainly up to debate, but you cannot debate that commodities have not been in a bull market since March of 2020. And therefore, you're buying a commodity that's near multi-decade lows. And again, that in itself, you got to be careful. Like I always say, oversold's not a buy signal. But I would say the downside is most likely very limited. Where's natural gas going to go? Is it going to go to zero on a bankruptcy filing? No. So you get down to this $2 level, and especially in a bull trend in commodities, I'm surprised it got this low. Whereas most other commodities are still well off their 2020 lows. So I just wanted to say that's what it looks like from a weekly. And again, you do have oversold plus positive divergence on the RSI. Shorter term, this is that chart I gave you last week. You have, let me change up the tool color here. You have these alternative downtrend lines. That was the primary downtrend line I had, and so that shows a breakout and a back test right here. There's your breakout, back test 1, back test 2, moving higher. And then I have also, as you can see, a yellow alternative or benefit of the doubt trend line there that came in a little bit higher, That one got pierced. So this is the better fit because your prices have respected that trend line. But as I said last week, the next buy signal is going to come on a break, and I think it should run if that happens above that 224, called 225 level. It's pretty good support. And then I already gave you the targets there. So let me see one other thing for you ETF, ETN traders. You want to use UNG. In my opinion, there's no reason to trade the leveraged natural gas ETNs because there's so much volatility, especially lately in natural gas. You don't need the leverage. I mean, this is a security that easily can go up double digits in a single day, 10% or more, and then do it again the next day and do it again the day after that. So why you need leverage? Why they even have leverage ETFs, ETNs? They're really technically on this. I don't know, but there's that's what it looks like on the chart of UNG. You've got just a big divergent low, positive divergence, waiting for a bullish crossover. It's likely to come at any moment here. You can see here on any more upside, and this was the last green trend, mostly sideways. We were still in a downtrend. I'll give it that. And remember, this is where natural gas peaked last year. But even then, there were some counter trend rallies, and in the bull market, or in a bull trend, which we may get a trend reversal here. That's what I'm looking at, an impending and likely trend reversal coming up in natural gas, and that's when you want to be long. These are powerful trends, and you can see it all along. So anywho, that's just that will give us a check mark. It'll confirm that positive divergence and consider natural gas higher up here to that third target there, about 1180. Okay, and let me wrap this video up by just talking about earnings real quick. As I mentioned, we have some of the big banks reporting this week, really on Friday morning. This is XLF, the financial sector ETF. We put in a divergent low recently on the 60-minute chart, but cannot so far have been unable to get through the 32.25 resistance level. This is what it looks like on the daily chart here. This was way back here. Swing trade laid out. T1 was hit early on after that break, and we went up, put in a marginal new two divergent highs, or really one larger divergent high, at which point I said all along it never would have exceeded a reasonable stop for T3, and so we went on, hit T2, hit T3, which was my final target, hit it again, but we're back to it. And in a bull market, when you come down like that, if that was going to be it, after the second tag at least, it should have been one and done. And here we are again, and it looks like a kind of a sloppy-ish flag, but somewhat of a flag. You had the impulsive leg down in XLF, and you just have this period of consolidation. I think the financials are going to take out T3 and head on down to this next support zone is what I think. But let's look at that real quick, and then I'll wrap this up. Let's go to Okay, two of the tools I use almost on a daily basis on the site. Well, it's at least this one now because we're in earnings season. You come in right here, resources, click on the resources tab. It brings you to the right side of the chart, support center. And one of my favorite sections is down here, tools of the trade. And so the ones I use a lot are the earnings calendar, especially now during earnings season. So you might want to check that one on a regular basis, especially if you're trading individual stocks. Or in the case of, even if you're trading only the indexes, you think you're diversified, you have 500 stocks in the S&P 500, 100 stocks in the NASDAQ 100. Well, guess what? Come the end of this month, when Apple, Microsoft, and all those big techs, they all report around the same week, within a week or so. And so you want to know, or at least be aware, that you have a much greater chance of being caught on the wrong side of a gap when those market leaders report. So you have the earnings calendar, and you also have the economic calendar, and you can check that for market moving events. But when we go to earning calendar, it opens up earnings whispers. I'm just going to walk through this week. You can see here as I'm clicking, BMOs before the market opens today, AMC is after the market closes, Tilray. So you have a lot of, I can see some of the big pot stocks coming up. There's Tilray tomorrow morning, and that's after the close today. Tomorrow morning, CarMax. You have Albertsons after the market closes, another pot stock there, Organogram. And then this is Wednesday. Wednesday after the close, nothing really market moving. Thursday, Delta, Progressive, Fastenal. Fastenal is a good tell on the economy as far as home builders, construction. They make a lot of screws and, as the name implies, fasteners, which are, so when they're, construction's booming or orders are picking up, then that's going to benefit their business, and vice versa when things start to slow down. So the market will be watching that, or traders will. And then the big one's Friday, before the market opens. The leader, the biggest financial one out there, J.P. Morgan. You also have United Health Group and another big financial, Citigroup. Oh, and Wells Fargo as well. BlackRock, PNC. Going to be a big day on Friday. So markets may want to flounder around, wait and see what those guys report. But I like to do this every earnings season. I always say that it's always a crapshoot holding a position of from a company into earnings, because it can go either way. But as I often say, it's been my experience that if the charts are indeterminate, if I don't have a strong opinion, then yeah, it's a crapshoot, and it can go either way. But when the charts are clearly bullish or clearly bearish, from my experience, that usually, not always, but usually, more often than not, dictates which way they're going to go after earnings. So let's just take a look at a couple. We'll take a look at a couple of the banks here. So J.P. Morgan, that's the biggest one by far. And what I see when I look at that is a stock that just recently put in this divergent high right here. Let me use my line tool. Put in divergent high, and it's been moving lower. Now it moved lower, and maybe that's all it needed. Maybe that played out. The divergence has played out for all it's going to play out for. But these divergent highs and divergent lows. Let me just point them out here. There was a divergent high right there, and it gave you this entire trend change, that correction. The bull market top back in 2021 came with a divergent high, and it gave us all this that didn't end until you had a divergent low. And so these are, again, the daily time frame is in my opinion, the go-to time frame, the gold standard for swing trading, if your time horizon is measured in weeks or months plus. And so in a bear market, this would say that, this divergent high, it's likely to be the catalyst for the next leg down in the bear market on JP Morgan. So, and if that happens, it's going to take, it's not going to be a good sign for the economy and the stock market. Why do I think that's going that way? Well, here's the bull market uptrend line. Remember, this is going back to the last bear market ended in March of 2009 right there. That was the last real bear market, in my opinion, and everything since, even this one, depending on what time frame, what metrics, which indicators you want to use, you can call it a correction so far. To me, it's still early stage bear market with more downside to come. But what I can tell you factually is that this uptrend line was a beautiful uptrend line off the 2009 lows. It caught a lot of reactions along the way, and this is when it was broken down by JP Morgan. But what happened then, it's like a patient crashing on the on the OR table, operating room table, and the doctor just pumps him so full of adrenaline. I mean, even if that patient technically died, if the heart stopped, put enough epi in him, you're going to get that surge. This is what the most massive amount, unprecedented amounts of stimulus, primarily to the financial system, quantitative easing, zero interest rates. That's what it did. So it really, and it's what I've called since then. I labeled that Ursa interruptus, bear market interrupted by the Fed. That would have been the end, I think, of the Great Bull and J.P. Morgan, but it got this last little, shot of adrenaline, if you will. But then it went on and broke it again, and that's it. So they just caused a little kickback. They took it back above the trend line briefly, and all that did. Again, this is as important as the daily is for swing trading. The weekly is even more important, especially for trend trading. Now, trend trades are your trades that are going to last measured well into months and so often in years. And so you look for these, negative divergences on the weekly, 29% correction. That was just a bull market correction. This was the real bear market. That was a 46% drop. I think it's safe to say a 46% drop in JP Morgan from top to bottom is a bear market. And again, the Fed kind of came in and changed the course of, altered the course of stock market history, if you will, by giving it that last little gas. But then we broke it again, And again, that's my take. So I think this one, even if the initial reaction's positive, I think the bear market is not over in J.P. Morgan. I'm looking for a bear market that's going to ultimately take the stock down a lot lower, somewhere in here, probably 82, 70, somewhere in there. Who else did we have? We had Citigroup, and that was a big one. This has been a zombie stock since the last financial. This was Citibank up here, Citigroup, back before the financial crisis. 500, almost a $600 stock. Small split adjusted or wherever we're at. And you can see it's just like, the Fed created a lot of zombie banks, and I guarantee you they just did that with the regionals and everything else, with everything they've done best. So I don't have much of an opinion on Citigroup, at least not on this weekly chart. All I can tell you is it's in a bear market, it's in a downtrend. Here's your primary downtrend line. It just checked it recently. Checked it there, and it's something to note. If it breaks it, hard to argue as anything but bullish, but you do have very good resistance there at 54, 55. So let's just say as long as this stock remains below 55, ideally below the downtrend line, it's in a bear market, and the next big sell signal will be a break below $40. 40, I have it at 40.34 right there. That's pretty much contained since COVID hit. It's contained all these pullbacks right here. So those are your levels to watch. All right, guys, I have no reason to go through each and every one. Those are some of the big ones. Watch the banks. Again, the markets will do what they want to do. I think we'll continue to see, based on the technical posture of the big fangs. I don't think they're going to hold up to the end of the month till they report. I think we'll see some profit taking at the least between now and then. But again, watch the levels. We're at support. I started the video with QQQ at support. We're at support again. We were there last week, and I do think that support level is going to give way sooner than later. But unless it does, let me make it very clear, it's not objective to short. It's objective to buy. You buy pullbacks to support. You don't short a pullback to support. You short if you didn't do it, you short a bounce back off support to resistance, like a back test of the trend line. That was a good shorting opportunity last week. Or you wait for a break of support and then you short. And then, my targets. I have arrow breaks along the way, but pretty much it's a lot more downside is what I'm looking at. And then of course the VIX. To be bearish to equity markets, to be bullish to VIX. That's the Mays. The Aprils are still trading. Let me show you the Aprils. These are VIX futures, by the way. There's the Aprils just poised, making that big divergent low. Remember, the VIX is still at support. The VIX, spot VIX, these are still all my targets. T5 is up here north of those previous highs. And then last but not least, spot VIX still at very good trend line support. This is spot VIX. This purple uptrend line is your primary trend line. Comes off the 2021 lows, and the VIX has been making these, it was making higher highs as well. Lately it's been making lower lows, but we're at support, and I think the next up is going to pop that trend line and take us up there, probably above that 3760 level if the VIX starts to rocket up soon, which is what I think will happen. Okay, let me wrap it up here, get the video out to you guys, and just a quick heads up. Starting tomorrow, and maybe for a day or two, I might not be able to get any videos out, and that's why I'm doing a long one here. We're doing a major pool renovation. They're coming in with an excavator and bobcats, jackhammers. They're taking out the existing pool, everything, including the stem wall and the footer. So it's going to be a lot of major demolition right next to my office. So I won't be able to record any videos while that's going on, but I will get charts out to you with any relevant updates. This has been Randy Finney with Right Side of the Chart. Have a great day.